The room is quiet before anyone talks about money. Across the table, a founder has a laptop open, a few charts prepared, and a version of the future that does not fully exist yet. The company is too early to prove itself. The market is still taking shape. The customers are interested but not committed. The product works, but only in the fragile way young products work before pressure starts finding the cracks. You sit near the end of the table, listening. No one in the room knows yet whether this is discipline or delusion. That is the tension venture capital lives inside. It does not buy certainty. Certainty becomes expensive once everyone can see it. Venture capital buys judgment before the market agrees. But before the system lets you decide, it gives you something smaller. It lets you look.
Level 1. Permission to see. At the first level, your power is almost invisible. You do not approve investments. You do not lead the meeting. You do not call a founder late at night and influence a board decision. You read. You read pitch decks before breakfast. You read founder bios, market maps, hiring pages, customer notes, product launches, competitor announcements, abandoned blogs, and small signals most people pass over because they do not know what those signals might become. Your job is not to sound important. Your job is to notice. A company with no press but unusual customer pull. A founder who explains the problem with too much precision to be guessing. A market where the language begins to change before the money arrives. A product that looks small only because the category around it has not been named yet. You see more than most people will ever see about how young companies begin, but you own none of it. You can flag, you can summarize, you can suggest that someone more senior should take another look. Then the decision moves upward into rooms where your name might be mentioned or might disappear completely. That is the first lesson. Access to information is not control. At this level, the machine is training your eyes before it trusts your hands. And once you can see the signal, the next question becomes harder. Can you test it? Level 2. Permission to question. Now you are allowed to ask questions that change the temperature of the room. Not dramatic questions, precise ones. Why did retention improve after the third month? Why are 3 customers responsible for half the revenue? Why did the first sales hire leave so quickly? Why does the founder describe the market as urgent when the buying cycle still takes 9 months? You begin to understand that a beautiful deck is not evidence. It is an argument. Diligence is the work of finding where that argument bends under weight. You look at churn. You look at retention. You look at customer concentration, hiring speed, burn rate, founder history, pricing power, and timing. But the real test is often quieter. A pause before answering. A number that changes between calls. A founder who becomes defensive when the question becomes specific. Another founder who has already lived with the weakness long enough to explain it without hiding. The numbers show the business. Pressure shows the person. At this level, the danger changes. You are no longer afraid of missing a slide. You are afraid of trusting the wrong version of reality. Because in venture capital, the right question can save years, and the wrong comfort can turn uncertainty into ownership. But questioning is still reactive. You are still working on opportunities that came through someone else's door. The next level begins when you stop waiting for the deal to appear. You start finding it before the market knows where to look. Level 3.
permission to originate. At the next level, opportunity no longer arrives in a clean folder. There is no neat process, no finished deck, no formal introduction, no obvious signal that tells everyone this is where the next important company begins. You meet founders before they are ready to raise. Sometimes you meet them before they fully understand what they are building. You take calls with two people still arguing over the product. You listen to unfinished ideas, strange markets, early customer pain, and businesses that sound too small until you understand the system they might eventually touch. This is where access becomes personal. Not the firm's access, yours. A founder answers because they trust your taste. Another sends you a note before speaking to anyone else. A former operator tells you about a small team leaving a larger company to build something new. None of this looks like power from the outside, but inside the machine, this is where power starts to move. The best deal usually does not begin as a competition. It begins as a quiet relationship before anyone has named the category. And that is the hidden cost. You have to prove you are worth meeting before you ever get the chance to prove you are right. But creating access is only one side of the system. The next question is whether capital will allow your judgment to stand in front of it. Level 4, permission to sponsor. Now the room feels different. You are not simply bringing information upward. You are attaching your name to a decision. The company is still uncertain. The market is not fully proven. The founder has rare strengths and weaknesses that may become expensive. The numbers are promising, but not safe. Nothing about this is safe. If it were safe, it would not need venture capital. Your job is to explain why this uncertainty deserves to become ownership. You stand in front of the partnership and make the case. Not with excitement, not with belief alone, with a clear thesis, a defined risk, and enough conviction to ask the firm to move real money through your judgment. This is where the mistake changes shape. At lower levels, a mistake can look like a missed detail, a weak memo, a bad assumption in a model. Here, the mistake becomes more personal. It looks like judgment. If the investment works, people remember that you saw something early. If it fails, they remember that you asked the firm to believe it. The spreadsheet will not carry the decision for you. The process will not hide you. Your name is now part of the risk. That is what sponsorship means. You are no longer just studying the machine. You are asking it to trust your hand on the lever. But sponsoring one investment is still not the same as becoming the face of capital itself. That comes later, when founders, boards, junior investors, and limited partners begin to look at you and see not just a person, but the money behind you. Level 5, permission to represent capital. At this level, people stop treating you as someone who studies capital. They begin treating you as someone who carries it. A founder calls when the company starts to fracture behind closed doors. A board member looks toward you when the room cannot agree on whether to wait, sell, cut, or double down. A younger investor watches how you respond, trying to understand which risks are real and which risks only feel frightening because the numbers are large. You are no longer outside the consequences. You live with them. The investment does not end when the money is wired. That is when the relationship becomes heavier. The company changes. The market turns. A strong founder gets tired.
A weak founder learns. A clean thesis becomes complicated by customers, hiring, pricing, competition, and time. This is where carry begins to mean something different. It is not simply compensation. It is not just a future payout hidden somewhere in fund documents. Carry is the signal that you no longer sell only your hours. You now own a small part of the outcome your judgment helped create.
And ownership changes the way pressure feels. You do not think in weeks anymore. You think in years. But representing capital is still not the same as raising it. The next room is quieter, older, and less impressed by conviction. Level 6, permission to raise capital. When you walk into the room with limited partners, the hierarchy rearranges itself. For years, founders came to you and asked for money. Now, you are the one explaining why someone else should trust you with theirs. The people across the table may manage an endowment, a pension plan, a family office, or sovereign capital. Their money moves slowly because it is designed to survive longer than any single market cycle. They are not interested in your excitement. They are not buying your confidence. They are measuring your discipline. They want to know what you believe. But more importantly, they want to know what you refuse to believe. They ask about losses, not just winners. They ask about fund size. They ask about reserves, concentration, valuation discipline, decision process, succession, and what happens when the market stops rewarding the story you have been telling. For the first time, you fully understand the symmetry. You evaluate founders under uncertainty. Now they evaluate you the same way. Your track record matters, but so does your restraint. Your ability to say no matters. Your ability to avoid turning access into overreach matters. Your ability to not damage the fund by accepting more capital than your strategy can honestly absorb matters. This is the hidden correction inside the venture machine. The person who deploys capital must also be granted capital. And if that trust holds long enough, the relationship begins to reverse. You do not just have access anymore. You begin to become access itself. Level 7, permission to become access. At this level, your name begins to move before you do. A founder mentions you to another founder. A limited partner asks for a larger allocation before the fund is even formally open. A younger investor repeats your thesis in a meeting, not because it is guaranteed to be right, but because the market has learned to treat your judgment as a signal. This is what access looks like when it becomes institutional. People no longer come only for money. They come because your presence changes how other people read the company, the round, the board, and the future. But this is also where the danger becomes colder. When too much capital wants to move through you, the hardest decision is no longer how to get more. It is how to refuse what would make the structure weaker. A fund can become too large for its own strategy. A reputation can attract more opportunity than judgment can safely absorb. Scale can turn discipline into performance, and performance into drift. At the highest levels, power is not the ability to accept more. Power is the restraint to reject what damages the machine that made you trusted. But even when you become access, you are still not the beginning of the system. Someone gave you permission before the market ever saw you that way. Final inversion, the permission before permission. Behind the venture firm, there is another room, quieter, less visible, farther away from the founder story. The allocator does not appear on the cap table. They do not sit beside the founder when the product launches. They are rarely quoted when a company becomes valuable. Their name does not move through startup circles with the same force as a famous investor. But they decide which funds receive permanent capital. They decide which managers are trusted before the results are obvious. They decide who gets another fund, who gets cut off, and who is allowed to keep choosing the future with other people's money. You thought venture capital was about who gets funded, but the deeper question is, who gets trusted to fund anyone at all? That is the final layer. The machine does not begin with the founder. It does not begin with the partner. It begins with the invisible permission behind both of them.